Rebecca Choong Wilkins joining us right now to talk us through exactly where we are in the story here, Rebecca. Certainly a few months removed from, us talking about the sort of idiosyncratic risks pertaining to individual companies, but we're still here.
We are still here. And I think, part of that is because investors now are reckoning with really what the reality is for this sort of massive sector. Once one of the most profitable trades in corporate bonds globally, of course, incredible juicy yields here. Now investors finding themselves in these really difficult positions, either dealing with this sort of enormous wave of defaults, a record number last year, or increasingly these sort of unfavorable terms when it comes to extending payments. So many developers seeking to delay their payments. Now, global investors, of course, in China have always known that they are back of the queue when a company runs into trouble, but there have been very, very few examples of what that really means. And one thing that's really interesting is when we look at how companies have tried to sort of negotiate and avoid an official default, investors have increasingly accepted these weaker covenants over the past few years. And now with these extensions that have very, very unfavorable terms in some cases, investors who are really wary about getting involved in multiple court cases to resolve some of these delays. It's time consuming, it's expensive, and there's a lot of them coming through, instead opting to waive their right to default and agreeing to delay payments. And that, some investors and some analysts think sets a really dangerous precedent for the market going forward.
A big part of this investment universe are property developers, right? And you had that property tax trial getting pushed back. I'm just wondering whether everything that was promised this week came too late, or was even targeted to help this part of the distressed market.
I think that's absolutely spot on. We've really seen this idea too little, too late. When it comes to sort of the response to the policy move, of course, we saw that staggering moves in other parts, other asset classes across stocks, for example. But in credit, the gains were much, much, much more muted. For high yield, really a 2-cent, 3-cent move here and there. The feeling is that this really cannot save the bulk of private developers who have been targeted in the clampdown. The worst has sort of been done for this market. And at the moment, the high yield market, the bulk of notes are actually trading below 50 cents of the dollar. So it will take an enormous amount of direct support to actually normalize this market and get it back trading to even sort of levels of 70 cents, 80 cents. And I think although we've seen some big gains for the strong developers, so Country Garden, Siffy, some of those better quality names will certainly be reassured by the promise of some kind of policy support. I think for the bulk of firms here, this really isn't enough.